Time now for Dollars and Cents. We're just a few weeks into the new year, and it's still a good time to rethink and reset your finances. To help, we're looking into ways to build better money habits. That starts with not storing your money in payment apps.
They're very popular, they're convenient.
Venmo, PayPal, Apple Pay, and Zelle are just some of the many payment apps out there.
Venmo and PayPal, the fun thing about them is that when you do use their cards, like their credit cards, you do get that cash back.
More than 3/4 of U.S. adults say they've used a payment app, according to the Pew Research Center. And the Consumer Finance Protection Bureau says transaction volume on these apps is expected to go from $893 billion to $1.6 trillion by 2027. But experts like Sacramento-based financial specialist Shane Correa Fernandez warn, while these apps bring convenience, they also come with security concerns.
We are in a digital world, and that also means that scammers and hackers are also getting a lot more savvy. Recently, I just had my accounts hacked, and it was pretty brutal.
Shane says hackers gained access to her digital card in her payment app through a merchant with whom she used her digital card.
Venmo and PayPal, they're great for those quick exchanges, but the pitfall is that just know that there are hackers out there that can get into your accounts digitally, and then it's a nightmare trying to get the money back.
Also, the Consumer Financial Protection Bureau says funds stored on payment apps often lack insurance. In contrast, when you store your money in an FDIC-insured bank, you are protected from losses up to $250,000. Okay, Shane, so tell us some of the best practices for those payment apps.
Definitely don't want to park a large sum of money. I mean, I usually have maybe $200 in my Venmo app.
If you do get hacked, don't wait to take action.
Setting up alerts so that if there's something out of the ordinary, your bank can text you. Don't wait, call right away and start the claim.
Experts say keeping your money in payment apps could also mean losing out on the interest from a high-yield savings account. So double check your app. Cash App and PayPal, for example, do offer separate high-yield FDIC-insured savings products. And one of your goals might be to save more. We're talking about savings accounts and what the new federal interest rate changes mean for you.
So we noticed the last couple of years, we were riding the wave of the interest rates increasing.
It spelled good news for your high-yield savings accounts, meaning the interest you earned also increased, at times reaching a high 6%. But financial specialist Shane Correa Fernandez says that's changing, with the Federal Reserve finally lowering its benchmark interest rate several times in 2024 as inflation started coming down after reaching record highs during the pandemic. So Shane, with some of the recent changes to the federal interest rates, what are some of the impacts for people's savings accounts?
When the Fed started decreasing the interest rates and inflation got under control, the money that banks were now giving us on our high yield savings accounts, the interest rate started decreasing. So now we're in the low 4%, and it's probably going to continue to drop.
Contrast that with a traditional savings account that typically earns barely half a percentage point interest.
But it's time to take a look at, okay, how much do I have in those accounts and where else should I be moving it?
You might consider other savings products beyond traditional savings accounts and high-yield savings accounts.
You might do a better job at your own individual brokerage account, some mutual funds, investing so that you at least make 6-7% annually. There's annuities that you can invest in.
Shane says these are some of the places you can put your money, watch it grow, and still be able to utilize it.
A brokerage account is very different from retirement. You have access to it. So if you needed money back, you could ask for it. Like, hey, send me back that money, or I need it. But while you don't need it, it's making money.
Shane says there are still some banks offering more than 4% interest on their high-yield savings accounts, so it could pay to shop around. Now let's talk holiday debt. Many of you may still be paying off those Christmas presents. What's the best way to pay it off quickly? An expert I talked with says it all starts with your budget.
I always say paying down debt is probably the best thing you can do.
30% of Americans say they expect to go into debt over the holidays, according to LendingTree, while Wallet Hub says 47% still have debt from last year.
Seeing people spending an average $1,500 extra a month on eating out. And then as far as gifts go, we do see an average of $3,000 being spent in December.
Sacramento-based founder of Golden Wealth Capital, Pam Rodriguez, says she's seeing an uptick in credit card use, while inflation and high grocery prices are making people more prone to dining out. New year, new money goals. And one of the popular goals that people have is to get out of their Christmas spending debt. Where do we start, Pam?
The number one place to start, and we say this every time, is taking a look at your budget. If you don't have one, creating a budget is the number one place to start.
See where your money has gone and make a plan. You can tame your credit card balances by paying more than the minimum due.
To make 2 payments in 1 month versus 1, and that automatically helps you put that little bit of extra money towards the interest only.
Too much debt can negatively impact your credit score. An aggressive approach to paying down debt can help you avoid high credit card balances and interest payments. Also, find places to cut expenses, even if it's just for a few months.
Netflix is probably on everybody's list of wanting to keep, but maybe an Amazon membership is not something you need.
Another way to help pay down debt is to stop using your credit cards, but don't close out your accounts, which can negatively impact your credit score. Just make sure those cards are not easily accessible. If your credit card interest rate is really high, just call your credit card company. It doesn't hurt to ask them to lower your interest rate. LendingTree says about 76% of people who asked for a lower rate actually got one, and the average reduction was about 6%. Now let's talk about your credit score. An expert I talked with says there are a lot of digital tools right at your fingertips to help you stay on track.
Everything from your living arrangements to how much you're paying for an auto loan is going to be impacted by your credit score.
Credit scores matter. They affect your chances of getting car loans, mortgages, credit cards, and other lines of credit. Lenders use that number to judge your credit risk and the likeliness you'll pay them back. Equifax, a credit reporting agency, says between 800 to 850 are excellent credit scores. New year, new money goals. One of those goals might include improving their credit score. Where do we start improving our credit score, Pam?
So you want to make sure that you're making payments on time. We all, of course, get really busy during the holidays, and it's really easy to forget about that.
Founder of Golden Wealth Capital, Pam Rodriguez, says paying your bills on time impacts 30% of your credit score. To help stay on top of your bills, Rodriguez recommends setting them on auto pay.
If you have your mobile banking app, usually you will be getting reminders on average every 2 weeks to take a look at your credit score if there has been any kind of update.
Updates you'll want to look out for include accounts you don't recognize. Double check your payment history and account balances are correct, and changes to your personal information. The Federal Trade Commission says if something doesn't look right, call the credit bureau and the business that issued the report. What can happen if they don't improve their credit score?
Not improving your credit score can cost you thousands of dollars.
Rodriguez says a poor credit score could have the most impact on one of the biggest purchases of your life, your home.
So a home loan will cost you on average anywhere between 1 to 1.5 points more if you have a low credit score versus somebody who might have an excellent credit score.
Meaning a higher interest rate. You could pay more to borrow the money needed to buy your home, that is, your mortgage, if your credit score is low.
Another thing would be if you are applying for even an apartment, you might not get approved if your credit score is not where it needs to be.
This is probably one of the most impactful goals that people can make this year.
Absolutely. They definitely are something that makes a huge impact in people's lives because it touches everything that you do.
If that isn't motivation enough, Rodriguez suggests engaging the help of a friend. Ask them to go on this journey with you to encourage you to do regular check-ins and have accountability. In dollars and cents, there's a viral budgeting hack called cash stuffing. It's getting a lot of eyes on social media, and it might be the thing you need to curb your spending and get your budget on track. Here's how to get started. No apps or high-tech tools required.
This week's cash stuffings, I have 50, 70, 90, 110, 130.
You've probably heard of the trend cash stuffing, but it's what I've been teaching for years. called the envelope system.
No matter what you call it, a lot of people online are talking about cash stuffing, the budget-making hack going viral.
What it is you take your budget and the categories you tend to overspend on and cash those out.
It's budgeting in its most basic form, literally stuffing cash in envelopes for specific needs. Can you tell our viewers a little bit about what cash stuffing is, and how they can get started and why they should do it?
Cash stuffing is going to be a little bit more of an old school way of, budgeting.
It's so simple to start. Get yourself a budget binder and a few envelopes and get to work. Figure out what you overspend on, like clothing or shopping, and make an envelope for that category. And then put a certain amount of cash in each envelope. And this is where willpower comes in. Don't spend more than what you've allocated for each wallet.
Once it runs out, then that's essentially all the cash that you had to use for that specific category.
It's a way to physically see where your cash is going and also curb online spending.
It makes it almost like a little bit of a game or more exciting when it comes to budgeting, because we all know we need a little bit of an extra incentive to actually stick to our goals.
So, if you're someone who responds more to the hands-on approach, this might be for you. Experts say it's also great for teaching kids about money. Cash stuffing is all about being intentional with your spending. Well, keep in mind, cash stuffing does take time, and that's really the point, to make you slow down and think about your spending instead of just clicking pay on a website. But if the effort is too discouraging and unmotivating, then another budgeting method might be more successful for you, like loud budgeting. It's another personal finance trend popular on social media. The point is to make better choices by sharing your spending and savings goals. It's all about being transparent and holding yourself accountable. But is this right for you? And could it put you at risk?
There is a recent trend going around social media called loud budgeting.
People going online, being vocal, and making a strong statement, all in the name of saving money.
Quiet luxury is out. Loud budgeting is in.
It's not I don't have enough, it's I don't want to spend.
Broadcasting your finances by loud budgeting might be just the thing to help you rein in your spending.
If you're going to be more accountable, you're more likely then to follow through. And so maybe you're more likely to achieve your financial goals.
Loud budgeting can help you resist impulse buys.
The more you're aware of these things, right, the more likely you'll make better and more informed decisions.
Many of you are struggling with the high cost of living and feeling the pinch just about everywhere. For example, the price of eggs and gas are up again, and even fast food's not as cheap as you remember it to be. Navigating these price hikes can be daunting.
We really know that, especially for younger people, their financial literacy rates tend to be low.
And so this loud budgeting trend that's taking off with Gen Z, people in their teens and 20s, could help them later in life.
The extent that those younger generations are more kind of aware of finances in general, might help them more towards that path of financial literacy, which is so important for making kind of responsible financial decisions.
But don't get carried away and share too much. Remember, you're not only sharing your spending plans with family and friends, but also strangers online.
Maybe a better way to go is to start with your friends and family, the people you actually know in your day-to-day life, and kind of see to extent how that works out before you start sharing everything on the internet.
If loud budgeting isn't for you, you could embrace a trend called no buy year. I talked with a financial coach who explains the rules and how you could make it work for your money goals. In a world where spending money is easier and faster than ever, more people are choosing to slow down and spend less. So many are embracing a no-buy year.
A no-buy year is a choice. So it's a plan for 12 months where you would commit to only spending money on things that were absolute needs.
Needs can include your housing payment, utility bills, and food. A no-buy year means not spending on extras beyond your needs.
It will help us slow down the time between the impulse that we normally have to spend and the actual decision to spend.
The rules are simple and you set them for yourself, totally customizable for your unique life situation. For example, let's say your weakness is buying new clothes just for fun or eating out every day at work. A no-buy year could mean wearing only the clothes you already have and packing your own lunch for the work week.
Someone who is a head of household and has children to provide for Maybe the no-buy year only applies to the adult in the family and not necessarily the children. So there's some life factors that need to go into the decision making.
By doing a no-buy year, Paley says you may notice a lot of your spending is on autopilot, so to speak.
Do you truly need it? This type of commitment helps you take the time to really slow down and really investigate what your true needs are.
A no-buy year has its challenges and rewards for sure. Before you dive in, try going online and search for people telling their stories and experiences of a no-buy year. Some models are more strict than others, but it's all about you and what you're comfortable with. If you don't feel ready to commit to this challenge for a whole year, try 1 month, a 30-day no-buy challenge, and see where that takes you. In dollars and cents, if your goal this year is to retire early, let's talk about something called FIRE. It's an acronym that stands for Financial Independence, Retire Early. It's a growing movement that's flipping traditional ideas of work and retirement on their head. I talked with a local financial coach about how FIRE can work for you.
Just talking about it has me feeling excited because I think a lot of times with money and finances, we feel that it's controlling us rather than us controlling it.
That's what FIRE is all about, controlling your spending now to have more to enjoy later. FIRE stands for Financial Independence, Retire Early, like really early. Imagine retiring at 45, even 35, instead of 65.
Folks who really throw everything that they have at this FIRE goal, at the Financial Independence Retire Early goal, they're usually living very simply.
Sacramento-based financial coach Maureen Paley says FIRE is a commitment that's not always easy, but can be worth the effort.
Maybe they're not vacationing once or twice a year. Maybe they're not buying a new car every 5 years. So there's certain decisions that folks in this community will make so that they keep as much of that disposable income that they have and put it towards investing wisely so that they can leave the workforce early and they can have that financial comfort in the future.
Anyone can live the FIRE lifestyle, and everyone's goals look different. But it all comes down to planning and using investment tools you might already have, like a 401k or index funds.
Their disposable income, which is what's left over after their bills are paid, their housing's paid, so on and so forth, that money is put in the service of growing more money, usually through investments, so that they can get to that goal much quicker.
The difference between being financially savvy and the FIRE approach is the level of aggressiveness. While most people put 10 to 20% of their paycheck in their 401k, FIRE people might put 50 to 70%. We live in a time of temptation when it comes to consumerism, and it sounds like living this FIRE lifestyle is going to take a lot of willpower.
It sure will. It will take a lot of willpower.
But Paley says you can find motivation through the FIRE community, getting inspiration from other people also trying to live the FIRE lifestyle.
When they see what's possible, and I think when they start seeing results after they start taking their first few steps towards that FIRE goal, they get really excited and really motivated.
The sooner you start FIRE, the more time you'll have to build up your investments and ride out some market volatility. Now let's talk about Social Security. Millions of retired Americans, including teachers, firefighters, and police officers, can expect to see their benefits expanded by hundreds of dollars a month. I talked with a financial expert about the new Social Security Fairness Act just signed into law this year and how it could help retirees make ends meet. But I'm also learning why they might be waiting a while before they see that money. Former President Joe Biden signed the Social Security Fairness Act into law January 5th, which repealed 2 decades-old policies. Get our viewers up to speed onto what it is exactly.
What happened was the Social Security Administration in the late 70s and the early 80s put into place 2 new rules.
Known as the windfall elimination provision and the government pension offset, together they reduced payments to certain retirees who receive pension income, like public school teachers, postal workers, police, and firefighters. The new Social Security Fairness Act aims to correct that.
because of this provision. And now that they passed this legislation, those individuals who had paid into Social Security are able to reap their full benefits, which previously were limited or if not eliminated.
Can you put in perspective how much people may benefit from this change?
I think total beneficiaries, it's estimated to be close to 3 million people nationwide should benefit from this increase. And the Congressional Budget Office estimated about $360 for those individuals.
That amount will vary depending on your unique situation. The Social Security Administration says it's based on factors such as the type of Social Security benefit received and the amount of the person's pension. Some people's benefits will increase very little, while others may be eligible for more than $1,000 each month. And it's not just retirees who could benefit.
Spouses now are able to receive a much higher benefit than what they were receiving previously, which is an important point.
Keep in mind the benefits hike under the new law would be retroactive after December 2023. Experts say it could take more than a year to adjust benefits and pay all retroactive benefits.
Now, the flip side of it is the cost. The Congressional Budget Office estimates the cost to be $195 billion over the next 10 years.
Beneficiaries don't need to take any action to receive the enhanced payments other than verify the Social Security Administration has their current mailing address and direct deposit information. SSA says most people can do that online with their My Social Security account. No call or visit to the SSA office necessary. Now, on the flip side of retirement, millions of high school grads will start college this fall. And with that comes some jaw-dropping costs, from tuition increases at state schools to $90 grand at some elite private schools. Students and their parents across California are faced with tough decisions on how to pay for college. A local financial planner I talked with says there are ways to plan for the increasing cost of higher education. The cost of attending college has gone up more than 150% during the past 4 decades. This as the California State University Board of Trustees approved a multi-year tuition increase starting this year, following a similar announcement from the University of California in 2021.
And Joe, we talk a lot about investments and making investments for yourself. Is college still a good investment?
I couldn't agree more. I do think every rule has its exceptions, but the statistics don't lie. It still makes a ton of sense.
So, how can you help make the cost of college still make sense for your family? Joseph Eshelman, the president of Tower Point Wealth in Sacramento, says there are huge economic and tax benefits to setting up what's called a 529 plan.
And not only does it grow tax-free, Laura, but then when you're actually making a withdrawal, which has to be used for educational expenses, the money also comes out tax-free as well.
Each plan is somewhat unique, and a student can be the beneficiary of more than one 529 plan.
More recently, they've liberalized that a little bit more to secondary school, primarily private school, but also educational expenses.
There are other ways to save for college. You might consider custodial accounts and UTMAs, which stands for Uniform Transfer to Minors Act. Eshelman says these kind of accounts don't necessarily have to be used for education, but have some tax benefits and are easy to shift assets to a child. But one drawback is when the child turns 18 or 21, that money is legally theirs and does not have to be used for education.
Starting with a newborn, that'd be great. If folks don't have as much time, what do you recommend if time is not on their side?
At Tower Point, we'll oftentimes recommend that a client not establish or fund a 529 for a student or for a child who's 14, 15, 16 years old, because A, that money is earmarked and pigeonholed specifically for educational expenses, and B, there's not as much of a benefit of that tax-free growth if the money is going to be needed or used just in the next couple of years.
So you might consider splitting the difference. Try putting half in a 529 and the other half in a regular account that you as a parent or custodian of the account can control. We have more advice for savings accounts and making a budget. Just scan the QR code on your screen. You can also see my other Dollars and Cents stories on our website, abc10.com, as well as streaming now on ABC 10 Plus. And remember, you can always watch us anytime, any day on your schedule by downloading the free ABC 10 Plus TV streaming app to your TV.